Give and grow. What is up? Eric and Ryan coming at you today. How you doing today, man?
I'm doing good. Just tired.
You look good.
Always tired.
How was the beach?
Beach is good.
Well, today we wanted to have a new video, and we want to talk about wealth mistakes that people make in their 20s and their 30s.
Mm-hmm.
And we can talk about this because we've been through our 20s, currently going through our 30s right now. So
yeah, that's crazy to think about that we're just in our 30s. That's funny.
I know.
We're actually gonna just be going through this list of items on entrepreneur.com. Money making mistakes or traps or things to look out for as you're going through your 20s. And we're also going to combine this with the 30s because, if you stop doing them in your 30s for whatever reason, you might be backsliding, and that's not good. So
yeah, absolutely.
So before we get into this discussion and our question of the day, I just want to ask if you can just please like the video, subscribe to the channel, turn on the notification bell. We got a lot of content coming out pretty soon. We're trying some new things. We're excited to be able to share more about what's going on with us and, this journey that we're on. We're all trying to help each other out. So yeah, if you can just do that for us, that'd be great. Our question of the day is going to be the topic of the day, but specifically for you, Eric. What are some mistakes or traps in your 20s?
I was actually going through school most of my 20s, but I still had a couple of jobs. I was waiting on tables at Firebirds. Before I got into OT school, I was a rehab tech. I was always tithing, but I wasn't even thinking about investing back then. And even though it wasn't like a ton of money, I just kind of wish I would have gotten into the habit or just like the psychology of it. Because, small snowballs, man, they add up.
It does.
Now I've been trying to make up for it in my 30s. All the time that I missed in my 20s, because, when you do the formula for wealth, time is so important.
Oh, yeah.
And I can't make up the time, but I can increase the amount that I'm investing now to make up for a little bit of that. So, but that's my biggest thing, man. I wasn't even thinking about investing back then.
Right.
It's kind of funny to think about how much I think about it now. It just was not even on my radar back then.
Oh, no.
But I hadn't read a book about it. I didn't watch a single YouTube video about it. I think I was really into, nutrition, health, playing video games, what most millennials were doing. But yeah, that's my biggest thing. Even if it would have just been, $10, $25, $50 a month, I just wish I would have started.
Yeah.
Just in a Roth or something. But that's my biggest thing. What about you, man?
Yeah. It's pretty much the same thing, time and also those stock prices back in the day, man.
Gosh,
insane.
I didn't even think about that.
I know. I'm not that kind of guy that's like, oh, well, I should have been investing in Tesla back in 2010 because hindsight is always 2020 or whatever. But knowing that, understanding how things work, like economic cycles, because I remember back in 2008, I would see headlines about the markets are going down, real estate is crashing, and I was like, what because I would look around me and I'd be like, I'm doing all right.
Yeah.
But a lot of people that were in the markets and were trading a lot during those times, a lot of them were getting destroyed. I think that the S&P dropped by 40-50%.
Something like that. Yeah.
And it obviously bounced back, but just seeing how much wealth can be made by understanding these things is something, kind of like what you're saying. It's something that I wish that I had back in the day. I have it now, but I didn't have it back then. But back in 2010, I was a senior in high school.
Mm-hmm.
And I've already mentioned this before, that I pretty much took a personal finance class, and that's where I learned about Dave Ramsey. So I had the behavioral part of it, but I didn't have the investing part of it. So that's kind of the thing that I wish that I could have looked into a lot more. And, it's actually really, really refreshing because, I'm starting to see YouTube videos of these kids, and they're I'm 19 years old, and, I got a Roth IRA, and it has $10,000 in it. And, they're doing very well, and they have a lot of time for that stuff to grow. So I'm glad that there's more people starting to understand that, if you start now, and you don't have to go crazy into it, but just start it and just have it be continuous, and you're going to be just fine.
Yes, sir. Are you concerned about, I say the current youth, but people in their teens, 20s, a lot of day trading, a lot of meme stock investing, like we've talked about before, it's kind of like a big casino.
Yeah.
Are you concerned that this is their this is how they're starting their investment careers or paths. Is that concerning you at all?
I would say so. A lot of these kids, well, see, they're not even kids. Like, it's a lot of people in general that haven't invested at all. Like, I mean,
yeah, I mean, even people in their 30s
yeah, because we'll take my example. I have a video on the channel where I talked about my biggest loss ever, which was on some meme stocks. The first time I put money into a brokerage account was to trade AMC. That was like the first time I even put money into an account was to trade AMC.
You lost on that trade?
No. I didn't.
Okay.
I didn't. But what I'm saying though is that like a lot of people are like, they see, the GameStop stuff that just happened recently. They see GameStop going from $10 up to $50, and they're like, oh, well, this is what investing is.
Yeah.
I don't need to learn about the economy and learn about economic cycles and interest rates and the Fed. All I gotta do is just put money into this one stock, talk about it, ride the wave, and that's all they know. And there's people out there where they're like, investing is so easy. You just buy, and then whenever it goes up, you sell.
Yeah. I mean, I remember like in 2020, people were just buying call options on Tesla.
Yeah.
Or even lower expiration date call options, and they're making tons of money.
Well, they're doing that now. Zero day to expiration is like huge right now.
Right.
It's hilarious.
But it's just like it's this big casino, and eventually the music is going to stop with all that stuff. And when it does, I hope that it doesn't. I hope it doesn't mold or crystallize the way they invest the rest of their lives, because there can be some heavy loss. I mean, I know like everyone's probably piling in on Nvidia, Apple, all the other big tech names right now, and they're loading call options. I hope they take a breath and realize there's a system to investing, and there's a reason for that. Yeah, and it's time tested. Enough about that.
Yeah, we can talk about all that stuff.
I mean, that's
all day, but
yeah.
Let's get into the meat and potatoes of this, which comes from this article. And a lot of these are going to be stuff that you already know, but it's not bad to like talk about them, because I know that when I was going through this list, there's a lot of things on here that I knew like way ahead of time. But imagine somebody, they're fresh out of high school, and they got people telling them, get a bunch of credit cards, and like, don't worry about, just pay the minimum, spend more than you make, which is the first one right here. Like that stuff will greatly affect you going forward. And if you don't change it, if you don't have the knowledge, you're always going to, you start to become biased to that. And as you get older, a lot of older people are like, well, I don't have any more time left. And that's a sad reality that I think that should be explored.
It's like what I sent you this morning. When you have a lot of credit card debt and you owe the bank a lot of money, that's another boss you have in your life.
That's true. Yeah, you might have more than one boss, or sorry, more than two bosses, because you'll have, you'll own the bank.
It's the
car,
it's mortgage,
it's lifestyle.
Yeah, those credit cards.
Yeah.
So,
but yeah, let's go into this real quick, because some of those things will be in some of the other ones on here.
Okay.
So yeah, the first one that I mentioned, spending more than you make, is a money trap in your 20s that you need to avoid. And, we talked about like credit cards, but really I want to start with like the psychology of it. If you go into the workforce and, because most people in high school, a lot of them, like they were living with their parents were paying for all their stuff or whatever. And when they first get that job or whatever outside of like high school to like maybe help pay for college, or even they just don't even go to college, there's like, oh man, I'm making money. I can do stuff now. I can live my life and it'll be okay. When you spend more than you make and you keep on going, you're like, man, like, what am I going to do? And then that's when you start relying on things like credit cards and like debt. And if you were to like just even, I mean, I'm not saying that like this is like optimal, but even like a base approach of like spending as much as you make is better than spending more than you make. Even though that's not ideal, because what you want to do is you want to budget, especially like taking care of your like baseline expenses. Like, you'd be surprised how many people, by the end of the month are like, we're always short like $500 on our bills. How is that possible? And it comes from you spending more than you make.
The world will distract you from these things. It's definitely like you're saying, you really have to have the desire to self-educate, and you got to find that higher self inside of you, because the
Right.
world is trying to distract you constantly.
Spending more than you make is a trap that you should avoid. See, I would argue even after your 20s, like going forward, because lifestyle creep will come. Like, you know, when you're trying to make some like good money after your job, and you're like, oh yeah, like I can afford. You know, we talked about this in a previous episode, where like people will tell you like, oh, like you can afford to do these things now. You make so much money, why not? But it's like, keep the lifestyle creep down and increase the amount you make over time. I mean, honestly, that divergence is like one of the biggest things, because like eventually, like, you know, when you got a ton of money, like 5-10 grand is like nothing.
Yeah.
You know what I'm saying? Like, you know, it's not going to be a big deal, but you might be handicapping yourself if you're like, oh, well, you know, I'm making like 70K a year now. I can afford to be able to live in like a nicer part of where I'm at, or I can afford to be able to do more things
Yeah, I
now.
can afford the fancy restaurants. I can afford the season tickets.
Right. Don't fall for that trap.
Don't think about it. It's just like a business. Your income is your revenue.
Yeah.
But don't get caught up, because if businesses just focus on the increase in their revenue, they wouldn't necessarily have success. Think about the cash flow. How much are you keeping in? How much are you reinvesting?
Right.
That's the mindset we're going for.
Right. Yeah. Number two, it's a kind of piggyback on that. Number two is not tracking your money. And this kind of goes into kind of like the budgeting aspect of it. But for me, I think that I've done a pretty good job over the years. I think that when I was younger, I was a bit more like, okay, well, as long as I have like $1,000 emergency funds, and as long as I'm paying my bills, I'm okay, and staying out of debt. But when I started to actually track everything, that's when the fun really started to happen. And you know, I was looking,
blows your mind.
I was looking at some numbers from like 2021 to like now, and just seeing like how much we put away during those times. I was like, dude, it took having to track everything and have guardrails on what we can spend. I know that over the years, I kind of like, you know, made my wife kind of follow a very, very strict budget. You know, it is something that like over time you can readjust depending on like how much you're actually bringing in, because, you know, eventually for me, it's like, whatever she wants, I'll get it. I'll do it. But to get there, it takes having to have that sacrificial mindset, you know, to budget, track the money. You know, if I wasn't tracking the money, the scariest thing to me is if you're literally just spending and you have, and like, you don't even look at your bank account. I'm not saying don't look at it every single day, but if you're not tracking your expenses and you don't know how much money you have, you might overdraft for all I know, or you might, you might be going back to the first one. You're spending more than you make. So if you're not tracking it, you won't know. It's data that's there, that's free to you, because you're the one that's actually doing it. And with like all these apps and, you know, even like spreadsheets that you can do, you know, we use the EveryDollar app. It does it all for us. Like with those, it makes it a lot easier to be able to see. And then when you see the results, it's, you know, and you see how much money you're saving, it's crazy.
Yeah, no, absolutely. I mean, I started budgeting this last year for the first time, believe it or not. And like I said, it blew my mind. Like I will always do this for the rest of my life. You got to know where that money's going. You know, and you just got to build systems based off that.
Right.
And, you know, when we went down to one income, we were still able to save a certain amount. We were still able to invest a certain amount. And we were still able to have, you know, we were still able to go to restaurants, but we just had to cut things back. And, you know, I say this all the time, you know, neither one of us have kids right now. So, you know, if we do have kids in the future, obviously, you know, that's going to change your, you know, your finances and your perspective a lot. So please know that we are aware of that, and we don't take that lightly. But if we have kids, I promise you, the systems are still going to be there.
Oh yeah,
and they're still going to work over the long haul. But things will definitely have to be adjusted.
Right. Like your budget will change, but as long as you're still tracking things and you're making choices on like, okay, well, do I need to actually, or do I need to be spending money on this when we're about to go over? Probably not. So, you know, we'll just scale it back. It's a never ending thing until you have FU money. You're literally doing this all the time. Like, you know, you could say that like, oh, well, you know, we're kind of comfy, but the thing is that you never know what could happen. We might have another 2008 financial crisis again, where the stock market crashes 50%, tail between your legs, and your entire thing is gone. But that's why going beyond tracking your expenses, it's just tracking everything in general. But with that being said, going into our third one, because this also piggybacks on that, it's not setting financial goals. I think this is something that's like really big, because when you're young in your 20s, you're not thinking about financial goals. The only thing that you're really thinking about is, how can I make money to do things that I want to do?
Yeah.
You're not thinking about where you are. The earlier you start your financial goals and you're like meeting them and you're being disciplined, the quicker you can get to something kind of like what we talked about in a previous episode. Like, you could retire early if you wanted to. You might have the option for that. You'll have the opportunity to actually retire, considering that most Americans can't retire. You'll have the options to be able to take more vacations in a year if you want to do that, have more money for yourself, set up your kids for the future. It just sets up more options if you set up your financial goals and you're actually on a path to achieve.
Yeah, you're taking the steps necessary to hit those goals. Yeah.
The fourth one that I wanted to go over today was living off credit cards. We talked about this one a lot. We talked about this one in the first point, because all these kind of like mesh together in some way. Just think about living off credit cards for a second. For one, it's money you don't have.
Yeah.
But you're also charged just to do it. So you got to pay money out of your pocket to borrow money that you didn't have in the first place. And most people are spending it on things that they don't need.
Yeah.
So that whole mindset is just ridiculous in general. Now, am I saying that credit cards are useless? No. Check out my credit card video. Funny enough, over the past month or so, we got like maybe 15,000 points from things that we've done. Those points turn into money. And I'm sorry to all the like Dave Ramsey people, but if you know how to do it, take advantage of it. I don't see a reason why you shouldn't do it. But it comes from a place of understanding how they work and keeping those guardrails there. But living off credit cards,
and you have no debt. You should
right. And you have no debt. If you have no debt, leverage the credit cards for yourself. As long as you're staying within that, then there's like, I don't see a point to you not doing it, unless it was something kind of like what like Dave Ramsey's team says is more of like a moral kind of thing, where like, the borrower is a slave to the lender.
Mm-hmm.
But the thing is though, is that over here in the States, at least, I don't know how it is over, everywhere else, but if you can take advantage of it, it's our job as like, people in finance to almost like try to find ways to take advantage of the system for your own benefit. Now, there is a point of like moral, there's obviously like a moral line to like everything, but credit cards, I don't see the issue at all.
I will say that more people will be taken advantage of by the credit cards.
Oh yeah, absolutely.
Versus the people that are kind of doing it the way that you're talking about it.
Right.
So if you don't, if you have debt and you've had issues with that before, just cut up the credit cards.
Right.
But if you get that foundation, you're cash flowing, you're building wealth, and then you want to take advantage of that to get yourself some points, whether it be for flying, hotels, vacations. Yeah, I mean, that's awesome. But I will say, you got to get to that point first.
Oh, yeah.
You're not going to just wake up and be like, all right, give me my credit card. It's time to start doing it. Like, you really have to have that foundation.
Right.
So be careful with credit cards.
Yeah. And that's the thing is, it says living off credit cards. Like, really, we live, me and my wife live off it, but it's because we have the money to pay it off. And that's the thing. Like, we're just using it as if we were using our like bank card.
Yeah.
And we're getting money off of it. And we pay it off at the end of the month, and everything is fine. And now we get to be able to use these points to pay, like what you're saying, pay for traveling, pay for hotels. We can even pay for different things that we bought in the past with these points. But it goes back to what he said. You have to have a foundation first. Don't let the credit cards take advantage of you. You take advantage of them every single time.
The system is always trying to take advantage of you through banks, credit cards, debt. But when you make your own rules and you have that strong foundation and you're building wealth, you get to take advantage of those systems.
Right.
But you got to get there.
And it feels good.
Yeah. And there's not a high percentage of people that can in the United States, in my opinion.
It's why it's important, like what he was saying too. Teach yourself. Find resources to help you understand these things. Do your own research. Teach yourself about financial literacy. Understand, the economy and the markets and all those things. And have a good foundation to stay out of bad debt and build assets, and you'll be just fine.
Escape the matrix.
So the last one that we're going to talk about is not having an emergency fund. Like what I said earlier in this episode, I had an emergency fund probably since I was like 18 years old, pretty much.
Wow.
It was $1,000, and since then that number has increased because I'm married and we have more things now to like keep in mind. But I honestly haven't had a time when something big happened and I had to use all of my emergency fund. Now, there was a time, I think it was like last year, where we had to fix up my wife's car, and that was like a pretty decent amount. We had the money to do it. Like, we had the money sitting there in the bank. In this case, my brokerage, which was collecting interest, and we were able to pay off the emergency and not sweat it. But imagine not having one, and then like your car breaks down. Or like, and this like unexpected medical thing comes up, or something in your house breaks and you gotta get it fixed.
Yeah, I would say, I remember when we moved into our apartment, and I was trying to like percentage wise decide how much I should keep in my emergency fund.
Yeah.
And I'd say the biggest thing, the washer and dryers both went out. There were random things with the car, like, getting oil. I had an older car back then, but I remember I was getting an oil change and they found like all this stuff wrong. And I don't know where it's like another $1,000 I had to, and that car didn't last much longer, but that was my Dave Ramsey car.
Dave Ramsey car. The beater.
But yeah, I like just keeping 3 to 6 months is good. But I like to have just like $2,000 kind of in the bank for emergencies. And then I like to have a bigger one. But the rest I kind of just keep in my brokerage, like you were saying, and just collect interest. And the only reason I say keep $2,000 in the bank, it's just more of like if something comes like really quickly, it's going to take a second to get the money transferred from my brokerage into the bank account. True. Whereas if I just have like that $2,000 in there, usually that can cover it, and then I can build it back up. Ideally, I would love to have like $21,000 in my emergency fund, because that would be 3 months of our average. What we spend on bills typically. Oh,
so your expenses a month is around $6,000.
$6,000 to $7,000, yeah.
Dang. Okay.
And that's something I figured out with my Every Dollar app. Yeah, I can go back and track it, and I was like, yeah, it kind of blew my mind. I was like, dang, like 3 months, 20, like it blows your mind.
But here's the thing though, is that your shovel is so friggin' huge that stuff is, whatever you're paying off is gonna be gone eventually. But
now that includes investments too, though.
Okay. Yeah, I was like, good grief.
Yeah,
$6,000.
That's not all. That's not all. Just expenses. That includes investments.
Okay. Never mind.
Yeah,
that was funny. I was like, man, we need to look at that budget again. Dadgum.
It's like he's like, who are you?
Yeah.
Oh, it's funny, but
yeah, having emergency funds. You could take Dave Ramsey's approach, which is like just have like 1,000, and we know that the 1,000 isn't enough, but the goal of it is to be like, I need to change my life to get on a path to get more in this fund, because the $1,000 is barely going to pay for anything. Inflation. Let's get real, but it's the psychology of like, I really only have $1,000 to my name. Yeah. I need to get myself, and that's the whole point of all that, is to get yourself on a path to do better.
Someone who's been living paycheck to paycheck, and they finally decide to change things up, maybe through Dave Ramsey, and they get that first baby step, just get that $1,000 emergency fund. Just think about the amount of peace you have just by doing that one baby step.
Oh yeah.
And I've never been there, but I can just imagine Like I remember when I first got my job, I was able to make an emergency fund. I was like, oh, this is great. You know, if something
Right.
breaks, you know, I've got this cash just for that. That is such a strong foundation
Oh yeah.
to beginning your wealth building journey, or just
Right.
changing different behaviors.
Yeah, yeah, and that's good because it's not about the $1,000. It's about the first brick on that foundation of wealth building. Like you have to have something to cover if something happens. You go forward to baby step number 2, pay off all your debt outside the mortgage, and then you keep on going. Now, like we don't follow the baby steps to a T, but I know that for people that are struggling financially and want to have that peace,
Yeah.
like Dave Ramsey stuff is always going to be the thing that I'm going to be pushing people towards. But yeah, emergency funds are great. And yeah, that's going to be it for us today about those money traps. And honestly, like the money traps apply to pretty much every single, in the 20s, it's more relevant because if you think about it, the earlier you start, the better off you'll be, but it's something that you have to maintain through your 30s, your 40s, and so on until, like I said before, you have the money to where it's like, it doesn't matter really what happens, but you want to have a foundation as early as you can, which is why we emphasize this being in your 20s. I want to end by asking you, like, what's a message that you would give to people in their 20s right now? I know you kind of had some stuff earlier, but if you can just think of some things that you would tell people in their 20s, what would it be?
It'd be simple. Good habits, they build on themselves and they compound over time. Set the foundation, build wealth. It's going to be trial and error with different things. Life is going to come at you, but as long as you stay focused, you stick to those systems, you keep taking those base hits, at the end of the day, over 10, 20, 30 years, you're going to be happy.
Oh, yeah.
You're going to have, you're going to have that wealth. You're going to have choices, and you're going to be able to help people too, So that's the big thing I would say. Make good systems, build on them, trial and error, and you're going to, it's just like a good stock chart. It's going to ebb and flow, but you're going to keep going up. So that's the big thing I'd say, man.
Yep. All right, good. Yeah, I definitely echo all that. Some like practical things. If you're in your 20s and you haven't opened up your Roth IRA, just do it.
Yeah.
No matter how much money you can even put into it. Now, like, you can contribute up to $7,000 a year into it, but take it from someone, I'm 31, I'm turning 32 in October. I missed out on 12 years of compound interest, pretty much. I missed out on that. So if you're like, even if you're like 25, the amount of growth that your account can have from 25 to my age right now, like it's a difference. And by the time you're ready to retire, we're talking upwards of like hundreds of thousands of dollars that you could have had if you would have started earlier. The earlier you start, the better.
It's never too late though.
Yeah. It's never too late.
You can always put more cash in.
That is true. I'll also say too, if you are, in your 20s, going back to one of our first episodes about the mindset of wealth building, the culture is going to tell you something that is going to lead you down a path that's not going to be good. They prioritize you borrowing a lot of money, spending on things you don't need, getting nice things when you're not ready to have them, over leveraging everything. And that leads to either you're going to be broke or you'll be living paycheck to paycheck. And, even just from an addictive perspective, lifestyle can be addictive. It's hard to break those things, but if you just ignore all that nonsense and focus on trying to build yourself up now, everything he just said, build good systems, have a good foundation, and understanding, how money works, compound interest. Those things are going to save you so much heartache in the future. And, if you have a family, it's going to set them up. It always starts with you. If you came from a financial illiterate family or from a family that, they're drowning in debt, they have a ton of credit cards, they have a bunch of things that they don't need, they're keeping up with the Joneses. You have the opportunity in your 20s, and even now, if you're not in your 20s, to be able to escape that, start now, and change the trajectory of you and your family's life forever.
I love it. I love
Yeah.
it.
But yeah, that's going to do it for us here on Give and Grow. Like what we said before, if you like this video, please like it, share it, subscribe it. We're trying to hit 1,000 subs by the end of the year. We're at around like 620 or something like that right now. We probably lost some. I have no idea by the time of this recording. But yeah, please help us out. If you have anything that you want to ask us in the comments, we use your questions for the question of the day. We want to hear from you. Please let us know there, because the whole point of this whole thing is to help grow together. We want to give things that we've learned, and we want to receive from you, because if it wasn't for other people in my life telling me things, I wouldn't know what to do. So let us know in the comments, if there's any traps you have that you're able to avoid, or things you're in now that we can be able to help out with. Let us know in the comments. But yeah, my name is Ryan. This is Eric. We're Give and Grow. We'll see y'all next time.